real estate, and managed a huge fund for a couple different organizations, billions of dollars, and really has his finger on the pulse and dialed in on the numbers, the metrics. Where is the Southside market? Where is the Chicago market? Where was it a year ago? Where is it now? And also forecasting, where is it going? What's happening to rents? What are they flat? What kind of units do people want to get in? I mean, I can't do it. All I can do is take notes when Brandon does his thing and send them 10 emails saying, hey, can you please share those slides with me?
And sorry that it usually takes 10 emails to get the slides out of me, Tony.
There you go, Brandon. Do your thing, Brandon.
Yeah, well, thank you for the warm welcome, and great to be with everybody today. As Tony mentioned, my name is Brandon Speck. I'm Director of Market Analytics for CoStar Group. And this is actually, I believe, my third time speaking for the group, but my first in 2 years. Can you believe that, Tony? It was 2 years ago
Wow.
that I last spoke in front of the group. And
right? Yeah.
A lot has changed. So the wrinkles are a little deeper. The eye bags are a little deeper now. I actually just welcomed a baby girl a couple weeks ago. So 5 children now, Tony.
Look at that.
We're still chugging along. So great to be with everyone today. I'm with CoStar. For those of you who don't know, CoStar Group is really serves as the MLS for commercial real estate, given the fact that there is not one. We also own a number of different companies. Most recently, we acquired homesnap.com. We just actually bought the URL homes.com. And then we also own apartments.com, Apartment Finder, 10X, LoopNet. Really all of these different platforms. And the big reason we own these platforms is one, obviously they generate a fair amount of marketing revenue in and of themselves, but they also provide us data, billions and billions and billions of data points. So currently we're tracking over 600,000 multifamily units in the Chicago area, over 500,000 market rate multifamily units, and over 60,000 multifamily units in the south side of Chicago. So we're going to go through some of that data today. So when Tony says I come with charts and I come with graphs, and it's not of my own doing. I'm fortunate enough to just be able to have access to this wonderful data set that we have. Before we jump into some of the numbers, I thought it'd be helpful just to give a couple, just very high level thoughts about where we are today in the commercial real estate environment now, 13 months post pandemic, still in a very, very low interest rate world, and still really in a heavily bifurcated economy. So when we think about just some of the trends that define not just multifamily, but commercial real estate in general in Chicago over the past year, first and foremost, a year ago, as we were witnessing it, we were going through the loss of over 500,000 jobs in the Chicago area alone in just 2 months. That's nearly twice as much as we lost throughout the entire great financial crisis of 2008, 2009, to really put that figure in perspective. And while we've been clawing those jobs back, we still today remain a couple 100,000 fewer jobs than what we had pre-pandemic. And the recovery that we've seen has been very, very K-shaped. And by K-shaped, I mean, one trajectory of our population has really had a hard time with the recovery, and really their prospects have declined over the last year, while a whole nother subset of the population has actually seen their financial trajectory increase or actually grow stronger. A lot of people are surprised to find out that the American consumer, the bedrock of the economy, generally 70% of GDP, is actually stronger today than at any point in time over the last 20 years. As I mentioned, we lost a ton of jobs, but where we lost those jobs, and considering the fact that the government has really just jumped in with a significant trillions of dollars of direct injections into the economy, have actually left the average consumer with more money in their bank account and less money owed on their revolving and car loans than what they had at any point in time in the last 20 years. So it really has been a bifurcated environment, for lack of a better word, because things aren't rising, right? We're no longer in 2017, 2018, 2019, where a rising tide was lifting all ships, and we were in record low unemployment rates, and everything we were seeing in the market made sense. There's been a lot more fracturing, and what this has done is really shifted the way money is spent within our economy and where money is spent in our economy, right? So right after the pandemic started, we saw an abrupt loss of demand in really the downtown market and in our north side. We actually saw the south side of Chicago perform very well and actually outperform from a demand perspective immediately following the pandemic. We saw a lot of people move out to the suburbs. We've seen a lot of people buy homes, right? It's the housing market that we're in right now, one of the hottest housing markets we've seen in, going back to 2006, is partially driven by the fact that we have seen so many people looking for more space because they've been able to keep their jobs, they've had stimulus checks, they've been able to forbear their student loans, and they actually have more money in their bank accounts today than ever. Also, it doesn't hurt that we underbuilt houses really significantly over the last 10 years, and at the same time have the largest generation in the history of our country moving through their primary home buying years, right? So when people ask, are we in a housing bubble? Can single family homes grow at 10, 15% per year while incomes grow at 4%? Absolutely not. But we are not in a housing bubble. This is nothing like 2008 and 2009. And the big reason is because this isn't an artificially held up demand environment like 2007, 2008 was, where we saw really, no credit mortgages and demand really propped up by easy financing. This is more demographically driven, as well as a supply constrained market that's really driving these higher prices. So that's just my thoughts on, where the market's at from a single family side. But as we know, multifamily and single family not just compete, but often complement each other in various markets, right? In markets where we see higher home ownership rates, where we see more homeowners, we tend to see rising multifamily values as well, right? So the two do combine to create a stronger overall community. Finally, diverging fortunes create significant bifurcation in performance across geographies and property types. Obviously, I think we've covered this. But let's just go ahead and define our geography very quickly. Tony, I just used the exact same geography you had defined out for me 2 years ago, so hopefully it's still applicable. But just when we talk about the neighborhoods today, and when we talk about what you're going to see is me present really two different kinds of data. First is Chicago, just the entire Chicago market, including the suburbs, and that's just to provide some relative perspective on how the Southside's doing relative to the entire Chicago area. And then you'll see me reference the South Side of Chicago. When I reference the South Side of Chicago, this is where I'm referencing, right? So these are the neighborhoods where I'm referencing. And when I look at that data set, we're talking about 55,000 total market rate units. Now, as I mentioned, we're tracking well over 60,000 units in the multifamily space in Southside Chicago. But what we've done here is we have excluded all of our under 5 unit properties, so all of our smaller properties, as well as all properties with secondary types like student housing. All the University of Chicago student housing's carved out of there, as well as senior and medical housing. And then it also takes out all rent controlled and rent restricted units. The reason we do this simply is just so that we're looking at an apples to apples comparison of market rent and what's going on in the market rate housing market. That said, if you're ever interested, we do provide data and do have data and do track properties on the affordable side as well. So high level performance, if we just look at, okay, where did that defined area, where we're looking at these 55,000 multifamily units, certainly not a small data set by any means. How did the market perform over the last year? Just as a very quick snapshot. Well, first and foremost, not a lot of construction going on. That's pretty consistent with what we've seen in the area for a while. It's very difficult to justify building in this environment. And that was before, we started looking at the new ARO requirements out of the city council. It's just really, really difficult in this environment to justify land costs, material costs, labor costs, and put up new housing. And certainly when we think about that dynamic over the longer term, to the extent that just very expensive economics of new construction continue to limit supply increases, especially in the south side of Chicago, that's obviously a very bullish pattern or trajectory for future values, right? Because simply speaking, then you're not seeing supply increases, you're seeing supply constrained by the lack of new construction. And generally speaking, that will provide more opportunity for a lift in values. Now, when we look at absorption, interestingly enough, this is over the last year, we've seen the south side of Chicago's multifamily market really outperform the Chicago area on a couple key metrics, namely being rent growth and on value growth. But one area where we really have seen some recent slippage has been on absorption. So over the last 12 months, we've lost about 220 units of total demand. You know, said another way, tenants moved out of a net 220 units relative to what they moved in. And because of that, we saw the vacancy rate rise by about 60 basis points to 7.8%. But market rents are up by 1.1% despite what's going on in the labor markets, and despite the fact that, again, we are seeing in so many properties in so many areas, tenants having issues meeting those rent obligations. We are still seeing landlords on new leases being able to push rents. So certainly that bodes well for just continued value creation. And then on the market sale price per unit, we're really flat year over year, about 127,000 on average, but we're going to walk through some of this data in greater detail. We're going to start with demand. So first and foremost, as I mentioned, we lost a little over 200 units of demand over the last year. And I mentioned right at coming out of the pandemic in the third quarter of 2020, we actually saw the south side of Chicago outperform. So the downtown hemorrhaged demand, the north side hemorrhage demand, and we actually saw this nice lift of about 150 units in the third quarter of 2020. We've since now seen consecutive quarters of losses, both in the fourth quarter of 2020 as well as the first quarter of 2021. And thus far through the first month of 2020, the second quarter of 2021, we've also seen demand losses. So certainly I think, you know, the fact that there are so many tenants who have gone, you know, a year without income, certainly unemployment is still elevated, especially amongst frontline service workers. We're starting to see that leak into the data. Yes, there are still moratoriums on evictions, and the world is still very, very complicated for you as landlords, but we're starting to see more and more tenants leave on their own account. We're starting to see more and more tenants, as leases roll, just leave, and effectively now obviously it's going to be a further fight to get dollars reimbursed from the government as being the landlord. But what that does give obviously you the opportunity to do when that tenant who hasn't been paying does leave at the end of the lease is release that to somebody who is paying. And the fact that we are seeing market rents continue to go up despite the fact that we've seen demand fall for consecutive months certainly is a positive and bodes well for landlords' ability to continue to replace that value that's kind of been lost over the last year. So when we look at total fundamental balance within the south side of Chicago, just taking a long view, decade look back view from a supply demand vacancy perspective, you can notice a couple things. First and foremost, you see our demand losses. Those are our orange bars recently. Not a lot of supply increases, which are blue bars. And you see vacancy has actually risen to about 7.8%. So it's interesting to note, Tony, that I mentioned the last time I talked to you was in the second quarter of 2019, April 25th, 2019 to be exact. And that was actually about the exact low point of what we saw from a vacancy perspective in the south side of Chicago. So that's when we were actually discussing 6.6% was the figure I told you back in the second quarter of 2019. We've since seen it rise about 120 basis points, but I showed you 10 years for a reason, and that's just to really put this vacancy into perspective. 6.6% was a historically tight vacancy rate for the south side of Chicago. Right, an 8% vacancy rate is still a very fundamentally sound, comfortable vacancy rate for the south side of Chicago, and still indicates a very healthy fundamental balance that still allows rents to grow. So while we have seen vacancy rise by about 1.2% over the last 2 years, we're still in what I would call a very fundamentally balanced market within the south side of Chicago. Now, that said, we got to stop the bleeding on the demand side, right? We can't lose too much more on the demand side before we are going to start to see that erode pricing power. So how does that 7.8% compare to the entire Chicago market as a whole? Well, first and foremost, the Chicago market's at an 8.2%. So we are seeing that multifamily housing is tighter in the south side of Chicago than it is across the Chicago market as a whole. And I mentioned that really there was one area that the south side of Chicago hadn't outperformed the market as a whole, and that was really on that demand creation in the first quarter. So as you can see here across the entire Chicago market, while not in the South Side, but still definitely, you know, we don't want to get too geographically constrained, because at the end of the day, we are all still kind of in a shared ship. We did see demand rebound nicely across at least the entire Chicago market in the first quarter. So hopefully that bodes well also for the South Side to be able to see that demand start to rise as we move into the stronger leasing quarters of the second and third quarter of the year. Overall, though, 8.2% vacancy rate in the Chicago market, the highest vacancy rate that we've seen going back over the last 8 years in Chicago. A lot of that is downtown. So the downtown Chicago market currently has about a 14.5% vacancy rate. And we are going to see another 2,300 units delivered downtown. So when we look at the Chicago market as a whole, we see a very, very bifurcated picture, very balanced fundamental picture on the South Side. I would say a less balanced, but a at least improved picture on the North Side, a very, very weak fundamental balance in the downtown market, and a very resurgent and very tight market out in the suburbs. So looking forward as we think about fundamental balance in the South Side, the nice thing is we aren't going to have to compete with a lot of new construction. So currently we're only tracking 60 units of new construction underway right now. When we look at this historically, you know, especially when there were a few of the larger projects underway in Hyde Park, you know, we've seen times where there's been upwards of 300 or 350 units of new construction underway within the South Side. So again, as I mentioned, it's just really hard economically to justify breaking ground on a new project today. And as such, we are expecting this kind of lower pace of new supply creation to continue into the future. So now just shifting over to rents. First and foremost, I just wanted to show you Chicago market rents as a whole, but broken out across geographies, because I think this really does speak to the big trends that we saw in 2020. And more importantly, how potentially the greater accessibility to vaccines, the fact that I think we really are all starting to feel hopeful that the worst of this pandemic's behind us, and we're all starting to feel a little bit more comfortable going out to restaurants. The benefit of being in the urban environment, I would say, is starting to feel real again. And I don't know if anybody else is feeling that as well. But back in 2020, really with the onset of the pandemic, people got scared of being around other people. And so we did lose a lot of demand in the downtown and in the urban environment, in the neighborhoods around the downtown core. And obviously that put a lot of pressure on rents. So as you can see here, at their worst, rents were down by about 11% as a whole, new lease rents in the urban market, right, in downtown and in the neighborhoods. But in the suburbs, rents actually finished 2020 up by 1%. Now, while fast forward to 2021, we've seen the suburbs continue to grow just because, frankly, there just aren't a lot of available units out there. Availability in the suburbs of Chicago right now is sub 4%. 96% of units are currently occupied out there. I mean, it's just very, very tight. But what's really nice is we're starting to really see a resurgence in the urban environment. So as you can see here, we're tracking rents that are up by about 4% just since the start of the year. And as we've started to really see the thaw on the leasing season, as we've started to see the spring season pick up, we've seen this rent growth accelerate. So we're hopeful that maybe we don't get completely back to where we were at the start of 2020 in urban rents, at least across the entire urban market, where we really are off to a strong start in 2021 as to trying to repair the damage that we saw in 2020. Now, when we talk about Southside rental growth, we actually see that it outperformed the Chicago market as a whole last year, and also the other urban environments. So as I mentioned, urban rents as a whole in Chicago were down by 10% year over year. But in 2020, they were actually up on the South Side by about 1.2%. We did see, as you can see by our line here, we did see some slippage, certainly in rents as the pandemic started to take hold in Q2 and Q3. But we really saw a nice, strong bounce back in the fourth quarter, and have seen that continue. Similar to other urban environments in Chicago, we've seen that really continue into 2021 so far. So currently, on average, market average rents are sitting at a new record high in the South Side. And obviously, as we all know, with a capital markets environment that's flush with capital and an interest rate environment that as we've already heard, that is highly accommodative to multifamily owners. Record high rents means record high values, right? At the end of the day. So it really is a good time to own multifamily on the South Side, so long as your collections are in order and you're not having too many headaches on that front. That said, there's certainly this correlation between occupancy and rental growth, right? So as I mentioned, we need to stop the bleeding on the demand side, and certainly there's nothing to say that we'll see continued losses of demand. I think we're working through, like I mentioned, some of those tenants that have been unemployed and maybe haven't been paying, and their leases are starting to roll in spring. We're starting to lose some of those tenants, and quite frankly, that's okay. I think the market heals as long as we're losing the tenants who can't pay, and we're replacing them with tenants who can. But that said, as I'm showing here, there tends to always be this nice correlation. Very few things more correlated in real estate, right, than the relationship between occupancy and rents. Generally speaking, the ability to push rents are subject to the ability to have a tight fundamental market and not have tenants who can easily get up and go somewhere else. So we are gonna, if we're gonna keep pushing rents, if we're gonna keep this blue market rent line moving up, we're going to need to see that occupancy line at least level off. It quite frankly doesn't need, as you can see back in 16, 17, we were sitting with a 91.5% occupancy rate and we were still pushing rents, but we really can't get much lower than that. So we really are going to need to see this occupancy rate level off if we are going to continue to generate 1.5% to 2% rent growth per year. Just wanted to show this because I just wanted to show the fact that CoStar is in fact tracking rents, not just on a quarterly basis, but also on a daily basis. So we are currently observing about 80,000 observations a day just in the Chicago market. We're observing about 10,000 observations a day in the South Side of Chicago. So when we use those series to estimate what's going on in rents, you can actually see here what you all know is true, right? Which is that seasonality in rents. What I really wanted to point out though, on this slide is just the brisk movement we've seen up in rents in the South Side from $1.44 a foot to $1.48 a foot. That's again happened just since the end of Q4 2020. So there really is this momentum, I feel like, that's moving behind rent. Jumping over to sales, another area where the South Side has certainly outperformed the entire Chicago market as a whole has been attracting investor attention. Not necessarily in an absolute manner, but in a relative manner, relative to where sales volume had been. So what you're looking at here is just total sales volume of all multifamily assets across the Chicago market. So for example, there was about $400 million of total trades that occurred across the Chicago market in the first quarter of 2021. As you can see, across Chicago, multifamily sales activity has really slowed down substantially as the uncertainty of the coronavirus pandemic has increased. Effectively, bid-ask spreads have widened, and a really accommodative financing market has led a lot of owners just to do refinances instead of sales. But when we look at the South Side of Chicago, we see that actually wasn't the case at all. We actually set a record high for new sales volume in 2020 in the South Side of Chicago. So over $400 million of multifamily sales volume. So thanks to people like Tony and everyone else on this call, really seeing just a ton of interest. And I'll tell you what, too, the interest has been, I didn't put the chart up here, but the interest has been not just from local buyers, but from national buyers as well. I don't know if you're seeing that in your world, Tony, but certainly in my data, I'm seeing more increase in interest in the South Side of Chicago from buyers outside of the Chicago area. So certainly, I think to the extent that continues, it's really bodes well for our ability to continue to push this blue line. And what that blue line is the average, CoStar's estimate of the average market value per unit in the South Side of Chicago in that area. And as you can see in 2020, we did see a slight fall, but here we are now back in 2021 after churning out decent rent growth so far in the first quarter, and we're back up to new record highs. And when we look at some of the information that we have, I did want to show this as well, just from a map perspective, where are we seeing the activity Generally well spread out throughout the entire region, but the greatest amount of activity from a heat map perspective or from a sales volume perspective has continued to be in that South Shore area. So we're just continuing to see a ton of interest in that South Shore market. So a couple other things I wanted to just highlight just to show the strength of the sales market in the south side of Chicago. First and foremost is CoStar serving as the commercial MLS or an official commercial MLS. We track not just what things trade for, but what they originally came to market for. And what you're looking at here is the difference between what the asking price when properties in the south side of Chicago were put on market, what that difference is between what they originally asked for and what they actually traded for. And as you can see, you go back to 2012, 13, 14, and there's oftentimes about a 20 to 25% discount compared to what the owner was asking for compared to what they've got. Now, fast forward to 2020 and now 2021, and you can see actually in the first quarter of 2021, owners in the south side of Chicago actually got more for their buildings than what they asked for. So you can see the really positive trend line here where that spread certainly has narrowed, and we're starting to see the landlords and the owners of Southside multifamily be able to command more pricing power, be able to commit more offers, or to be able to get more interest in their buildings, and as such be able to really narrow that spread around what they're asking, what they get. I always think it's interesting just to have an understanding from a per unit perspective, where are we seeing the sales? So the greatest amount of sales in the south side that we are still seeing are in that kind of 50 to 100,000 per unit range. That's about 36%, a little over a third of total sales. But we're seeing this is over the last 5 years, by the way. So, but we're seeing more and more of those deals really creep up over 100 and into that 110,000 per unit range. So again, just kind of continued justification for price growth that we're seeing. Another way to look at it, obviously, is our transaction cap rates, right? What are cap rates doing in the south side of Chicago? And as you can see, you know, the inverse of what we saw from our sale price differential chart, where we saw that rise or the narrowing of the spread between what owners were able to get versus what they were asking. Here we see cap rates indicating increased value and really increased interest in Southside Chicago. As you can see, kind of this long-term trend in cap rates, really from what were 12, 13% pretty consistently, now down to what traditionally actually are well below 10%. From a cap rate distribution, where I say traditionally they're well below 10%, here's where you can see that over the last 5 years in the South Side. We've seen really the lion's share of deals occur under 10% of cap rates, and nearly 40%, 4 in 10 deals command somewhere between a 6 to an 8% cap rate. So it really, again, speaks to just, you know, I almost the institutionalization, if you will, of the South Side of Chicago's multifamily, and the fact that we are gathering interest from a much wider pool of potential capital, and the ability to use that interest to drive up pricing or down cap rates. So that's made obviously a lot of owners consider selling. So we have a lot of units still on the market, but this hasn't affected pricing. And actually, if you want to compare where we're at today, how many units are on the market today in the South Side of Chicago, about 2,100 compared to 2020 and 2019. We actually have fewer units today on the market than we did at any point in time over the last 2 years. So values are up. And again, I think a lot of this also is because we are seeing so many owners use those higher values to refinance and not necessarily sell their asset, but refinance their asset. Certainly, as we start to look at big tax changes, potentially such as step up of basis, elimination of 51, and some of the other things that we're potentially hearing pondered about in Washington, I think we could see more and more owners decide, especially owners sitting on significant capital gains, deciding that now may be an opportune time to sell, just given the fact that the tax implications could be much more severe in the future. So where's the average asking price for sale units? Remember, I showed you that chart that said that owners are getting their price, right? That differential isn't 30, 40% like it used to be. It's not even 15%. Heck, in the first quarter of 2021, they got more than their asking price. Well, their asking prices have been going up as you would expect with cap rates falling, right? So again, people are asking for more. They're getting better, higher or lower cap rates, higher values, and they're getting their price when they're asking for it. So certainly, we've continued to see, I'd say, a lot of strength in the sales market in the south side of Chicago. That's all I had for you, Tony. So 2,000 words, 30 minutes, but I'd love to take any questions if there are any.
Awesome presentation. Can you go back to that heat map? I noticed some velocity in the Auburn Gresham market, which is probably that's exciting, and we're seeing some things right outside of Inglewood, the Greater Grand Crossing. I see some red over there, and of course the Chatham Avalon Park as well. So this is exciting to see sales, the sales activity continuing to be elevated. I think you might be, instead of 2,200 units, I think you're under about 1,900 because Frank just sold 230 units today. So there's less units on the market.
Congratulations, Frank.
But yeah, so tell us about this. What can you dig in this a little bit and tell us what this all means?
Yeah. So are you talking about from a presentation perspective as a whole?
Yeah.
Yeah. So I mean, really, I would say what it all means is, in my opinion, despite what I thought was going to happen in a world where we lost so many jobs and where there has been so much economic pain, the support of the government has been really successful in not necessarily always making sure landlords get paid, but propping up and keeping the value of multifamily buildings intact, right? Yeah. And actually, I do think that dichotomy this year is going to bring more opportunity and more deals to market, because you do have landlords who aren't getting paid who maybe think now's a good time if I can get full pricing for my building. Yeah. And you have landlords who are saying, hey, I'm seeing where values are going and I'm seeing where all of these trends are going. And I'll tell you what, they're only pointing up. And so I'm going to get in now. And I do think that is going to create some more opportunity where we are. I wouldn't be surprised, quite frankly, if we see 2021 surpass 2020 from a deal volume perspective, and we see another over $400 million year in the south side of Chicago.
I agree with that, because the property owners have been so busy just kind of working through this new normal, if you will, and dealing with all the new challenges as well as all the challenges they had before. And they really don't know. And when we dig in and peel back the onion on the properties, when you add in the government rental assistance programs and the fact that there's some tenants that are doing taking advantage of the system, but for the most part that's the anomaly. That's not the norm. And when we get through, the good has outweighed the bad as far as, and the values are a little bit better than they were 2 years ago. Or a year ago even. So
it's the exact opposite of what happened in 2008, 2009. So I was in 2009, I worked for a commercial bank, and we were taking properties back, right? And everybody was over leveraged, and everybody was trying to grab whatever piece of whatever they could, right? Nail the chairs down because somebody's going to come in and try and take them as collateral. This time everybody kind of put their hands in the air and played nice, right? And nobody moved. Everybody's going to play nice in the sandbox. Nobody's going to go force anything. And what it's allowed us to do is work through what could have been a very tumultuous situation in a relatively orderly fashion and get through it on the other end with values intact, right? And it almost speaks to the power, not to get soppy, right, of humanity when it actually works together in the common interest of getting through a very difficult period.
Yeah. And yeah, this is exciting. Thanks for sharing that. Anybody have any questions, drop them in the chat. Feel free to turn your microphone on and ask us a question. It's rare that you get Brandon here to kind of dig into the database. I know I would be at a loss if I didn't have CoStar. Every day I'm in there, getting data and trying to understand the market, where it is, where it's going, price deals out for the owners, and understand the rent trajectory as well. Where are the rents and where are they going?
Hello, can somebody hear me?
Yes.
Hey, this is Derek Price. I'm trying to find out how granular does your CoStar analysis go down? Does it go down, is it just by neighborhood? Does it go down census tract, or can I get a block by block analysis?
So it does, we do track it down to the property level. So you can go down in as much as to pull, 8 to 12 unit buildings on this certain street. It's a really dynamic database. It's a web-based portal where we've taken a census approach to effectively tracking all commercial property in the entire country. We actually fly a plane over the market and geocode every single parcel twice a year to make sure we have everything. And so it allows you to get as granular as you'd like. And if you're interested, I'd love to put you in contact with an account exec on our side. Sorry, Tony, I didn't mean for this to be a sales pitch.
That's good. No, this is good. Yeah, let me tell you. He can't tell you like that. Okay.
Yeah, and then also I'm on the phone, so is there a copy of that presentation you can get?
Yeah.
I'm not.
Email Southside Investors at gmail.com and we'll send it to you. But yes,
okay.
It goes down to the property level. We can put in your property address typically, and in 32 seconds have a 100-page report on where your property fits in the marketplace.
So how do y'all get the private data from them? You still got a lot of Southsiders where you got a lot of owners, they just own and manage their own property. Y'all just extrapolate that or what? Or you actually go talk to them?
So we have multitudes of ways that we get our data. So first and foremost, the ownership of apartments.com, rent.com, those platforms push us a lot of data. We have over 2,000 researchers who are calling property owners all day long. We're actually the second largest research organization next to the Census Bureau. And every one of our researchers, US-based, college educated, been trained in commercial real estate. And then we also employ web scrapers, because once we have a property and we understand, we pull the titles on all the properties and we have feeds with the county, so we know who owns it and we know what the loans are on it. Then we can very easily know what the name of the property is. We run web scrapers on a couple million properties a day that are automatically, if you put anything online, we're effectively pulling it. Pulling things from the SEC, so anything that's publicly traded. We have a direct line with Intex, which is a commercial mortgage-backed security provider. So we have the data and information on anything that's ever been financed by Fannie Mae or Freddie Mac or any of them. So there's a multitude of ways is really, I guess, just the best way to say it, because at the end of the day, it's a very difficult process to track billions of data points on millions of properties, and it takes a really large ecosystem.
Yeah.
Okay. I appreciate that. Mm-hmm.
You please turn your mic off. Mute if you're not, because we're getting a little bit of feedback. Yeah, they're flying airplanes over. I didn't know you guys flew airplanes over and tracked all the parcels. That's pretty cool.
We do also offer the opportunity for clients to go up in the plane when it's in market. So Tony, if you're interested and you're not scared of heights, we can go up in the plane and you can see it in action.
I totally do it. I'm in.
All right. I'm going to take you up on that. I'll let you know when it's in the market next.
Look at that. Awesome.
Hey, Tony, this is Sandeep. I have a quick question.
Sure.
Brandon, first of all, thank you. What a great resource for you to come here and talk to us about this. I think it's just such amazing data to get in one place. Tony, thanks for setting that up. Brandon, I just have a question. That heat map is, I can go back to that heat map. It's very interesting. That South Shore, there's a large pocket in South Shore, obviously, that kind of stands out. Are you able to see kind of what is driving that, or is that more of an institutional play, or is that because that kind of concentration looks very heavy compared to the rest of the South Side? So can you comment on that at all?
Absolutely, but I'm going to need 1 second. Sorry, I'm running my CoStar search right now because it is
That's the market where Frank just did that deal at. I'm telling you, it's Frank. Yeah.
So let's see here. Actually, Tony, if you don't mind, I'm going to share my screen one more time.
Yeah, go for
We
it.
can
Go
show
for it.
people what we're looking like. So right now we're in our sales comp section. So this is just looking at the sales. So let's do property type, multifamily, filters, location, do the neighborhood. So let's do, after 4/29/19. So it looks like we got 128 multifamily sales. Some of them are very recent, so we're just still getting the sale price in on them. These are the largest. And then we can also do, if we go to analytics, then we can look at who's doing the buying and the selling and roll up all of the data. So I can tell you here, like, Dooley Development, Trinity Food, Belvron Real Estate Partners, Goldman Investments, Top Buyer Broker.
All these guys on the south side buying, they got a lot of people out of town buying South Shore.
Yeah.
You know who Goldman Investment, I think I know who that is. That's the attorney that got disbarred.
So
He was a real
here's,
estate broker. That's his son, probably. He got
No,
disbarred.
That's a different guy. He's a guy out of Texas. Goldman is out of Texas. The guys that got disbarred is a different group.
and so this is where you can see too, as well as like buyer type. So whether it's an institutional buyer, whether a national or they're a local. So we tie everybody back to their main office. So, if they are a local buyer or a national buyer, we also have the ability to click in. And we do have a portal of all commercial real estate owners. So we track everyone's portfolio. We could tell you what Blackstone owns, what they're buying, what they're selling, and then who you need to talk to. So we have their email address, their phone numbers, their fax. We have what they own. We can look at their properties and look at what everybody owns. We can look at what, if they're buying, if they're net buyers, if they're net sellers.
Wow.
What they've been doing. And what this really does is obviously allow you to identify opportunities and then to know who you need to talk to. So we have about 330,000 commercial real estate professionals who are currently licensed with CoStar. And it's the primary, I think, platform. It's almost like the Bloomberg terminal for a real estate practitioner.
Yeah. There was a recent upgrade too, right? International something.
Yep. International data just rolled out, as well as the information on CMBS loans. So you can imagine, if you're a debt provider, the ability to look at all properties with maturing loans between $5 to $10 million, maturing 6 to 12 months from now. Well, you've just created a contact list in less than 5 minutes of people you should be calling to see if they want to refinance their property. Or sell their property, right? So sorry for the sales spiel there, but it teed me up too perfectly. Sorry.
Really blown my
I'm a buyer. Keep more CoStar.
Thanks for that.
Absolutely.
All right, guys. Well, thanks. If there's no more questions, I think this was a great meeting. Brandon always brings really good information for a while to really understand and unpack everything. But this was awesome, Brandon. Really, thanks for dropping in on us. I know you got a lot to do, newborn and everything. But thanks again for sharing with us.
Absolutely. Thanks for having me. And I'll tell you what, Tony, I'm going to email you the slides right now and save you the 10 emails. I know you're a busy guy.
I just like emailing you. Come on, man.
Well, still email me.
Yeah, all right, there you go.
It doesn't have to be about slides.
There you go. All right.
All right. Have a great
Anybody
night.
that wants those slides, email me at any one of my email addresses. I'll share them for sure. Okay. And I'm gonna motion to adjourn the meeting, and thank you guys for showing up and spending some time with the SSCIA today.
Great. Thank you, Tony.
I second that motion.
Look at that. Motion carries.